Welcome in this video. Will Xn coin price peak? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. When the current technical structure on the chart is carefully examined, it is possible to observe that the price movement has been moving steadily and consistently within an upward channel over a certain period. Such structures are called rising channel or ascending channel in technical analysis. Rising channels are very important formations for both investors and analysts because they indicate that the price moves rhythmically between certain support and resistance lines, and if this pattern holds, the uptrend is likely to continue. In this specific structure, the price oscillates between the lower and upper boundaries of the channel and occasionally moves back and forth between these two main lines. In such a channel, the lower band is usually considered a dynamic support level, while the upper band acts as a dynamic resistance. The middle line of the channel is generally viewed as a balance point, where the price either tests it and continues upward or consolidates briefly. In the currently observed structure, it is clearly seen that the price has retraced down to the lower band of this rising channel. From a technical analysis perspective, this area is extremely critical, and historically when the price has touched these levels, buyers have often stepped in and pushed the price back up. This indicates that the lower band functions not only as technical support, but also as psychological support. If this scenario repeats, meaning the price finds buyers near the lower band and rebounds upward, the channel's middle band becomes the first technical target. Since this middle band represents the average slope of the channel, it is the natural equilibrium zone within the trend where the price continues to rise steadily. Reaching this level is considered a sign that the price maintains its rhythm within the channel. The price holding at the lower band and moving upward shows that market participants still trust this rising trend structure and that it remains valid. Especially large investors and algorithms shape their positions based on such channel structures. Reactions from the lower band are therefore not ordinary buys, but may be points where systematic and planned strategies come into play. Moreover, every touch within the channel demonstrates that the price moves with a certain rationality, and that the market is not chaotic, but organized. This structure provides the investor with clarity not only about direction, but also regarding risk management. For example, buying when the price reaches the lower band and placing the stop loss slightly below the lower band line are both considered technically and logically sound moves within channel trading. If the price moves from the lower band toward the middle band, it is expected that this process will be technically reinforced by various supports. Key factors such as whether the price can surpass previous highs or form a new higher peak are crucial to understanding whether this move is merely a correction or the start of a new impulsive structure. Additionally, if the price breaks above the middle band and heads toward the upper band, the possibility of a channel breakout upwards arises. This would indicate that the trend is gaining momentum and a steeper rising channel may form. In addition to all these analyses, investor psychology is also an important factor in the formation and continuation of these technical structures. The fact that the price has repeatedly bounced up from the channel's lower band level before shows that the market accepts this level as strong support and tends to buy when this level is reached. This also proves that technical structures are based not only on mathematical or graphical factors, but also on psychological foundations. But we can't decide on the analysis by the channel alone. Let's also look at other metrics. Stay tuned. From a technical analysis perspective, when carefully examined, there is a clearly visible significant descending trend line on the chart that has caused the price to move downward for an extended period. This trend line acts as an upper resistance level for the price, where selling pressure consistently dominates, and market momentum is generally negative. The price has touched this descending trend line multiple times, but has struggled to break above this resistance area for a long time. This indicates that market participants have strong confidence in the prevailing selling pressure. The descending trend line is an important tool in technical analysis to determine the overall market direction. This line is created by connecting the peak points of price movements, which usually act as resistance levels. When the price remains below the trend line, the dominant market direction is typically downward, indicating a period when investors are more inclined to sell. Therefore, the inability of the price to break above this descending trend line suggests that market indecision and uncertainty persist. However, market dynamics are constantly changing, and over time, this descending trend line may begin to weaken at the points where it is tested. Especially after the price has touched the trend line several times, suitable conditions for breaking this resistance area start to form. Such a breakout is generally regarded in technical analysis as a signal of a radical change in market direction and the beginning of a new trend. At this point, the price moving above the trend line indicates the emergence of a new buying wave and positive momentum in the market. The currently observed descending trend line serves as an important boundary that the price has stayed below for a long time. This boundary functions as a barrier restricting price movement in both the short and medium term. The price's difficulty in breaking this barrier shows that investors remain cautious about the formation of a new trend and that market participants have not yet fully embraced bullish expectations. However, by nature, markets often produce strong breakouts following such prolonged resistance tests. If the price decisively breaks above this critical descending trend line, this move represents a very important technical turning point. Because this breakout signals that selling pressure has weakened, buyers have gained control in the market, and upward momentum has started to strengthen. In such a scenario, a rapid and sharp price increase is highly likely. These kinds of rises usually indicate the beginning of a new bull trend and create significant opportunities for investors. At this stage, for the breakout to be solid and valid, the price must not only surpass the descending trend line briefly, but also remain above it. The price holding above this line after the breakout provides both technical and psychological confidence to investors. As a result, market participants accept this new level as support and hesitate to sell. This condition lays an important foundation for the continuation of the upward movement. A strong upward move should also be supported by trading volume. High trading volume observed during the trend line breakout confirms that this move is not false, that there is serious buying interest in the market, and that the rise is sustainable. This contributes to the price rising quickly and sharply. Technical analysts and investors generally use this volume increase to assess the reliability of the breakout. In the world of technical analysis, there are many indicators used to determine the strength and direction of trends, and one of them is the vortex indicator, which has recently been highly preferred by traders and has shown high reliability. The vortex indicator is considered to be a highly effective tool, especially in capturing trend reversals in the markets, measuring the strength of the current trend and understanding whether the trend will continue or not. In the current analysis, there is a noticeable movement on the vortex indicator, with the blue line rising upwards towards the upper region, indicating the potential for this uptrend to continue. To briefly explain the working principle of the vortex indicator, it consists of two lines. One is the blue line, which usually indicates a positive movement, and the other is the red line, which represents a negative movement. The positive line indicates an upward movement of prices, while the negative line indicates downward pressure. The position of these two lines in relation to each other, and their tendency to rise or fall, are key to interpreting the overall trend direction of the market and the strength of the trend. In particular, when the blue line is above the red line and at high levels, it symbolizes a strong buying momentum and the presence of an uptrend in the market. Vortex is bullish as long as the blue line remains on the upper side. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.